earn 500% more than the cost of a loan. How? You want to do it using max funded indexed universal life. In this educational episode, I'm going to address this question: how do savvy investors, people who understand money and how it works, borrow from insurance companies and actually earn as much as 5 times or more than the actual cost of the loan? Get ready. I'm going to blow you away. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for nearly 5 decades. And I've helped many thousands of people optimize assets, minimize tax, and empower what I call their authentic wealth. So a lot of times people ask me questions because maybe they've read concepts or heard about them on this YouTube channel where I have over 1,000 educational videos. And if you would like to be notified every time I post a new one, which I do 5 days a week, please subscribe. Maybe you would like to read and study some of my books. I published 12 books thus far. At the end of this episode, I'm going to gift you my 11th book, which will blow you away and help you understand what I'm about to teach you. You'll soon learn that one of my favorite financial vehicles is a max-funded indexed universal life insurance policy, structured correctly and funded properly to be used for living benefits, to turn into a tax-free cash cow, to where during my lifetime, since 1980, when they were first introduced by E.F. Hutton, I've averaged 9.62% rate of return. Your money will double every 7.5 years if you do that. But ever since indexed universal life came out in 1997, I've actually averaged 11.17 and netted 10.07, meaning the cost of the insurance and all the fees only used one of the percentage points, which is frankly money that would otherwise go out the window in unnecessary tax. If I followed the herd and put my money in IRAs or 401ks, I'd have to be earning 16% in a tax-deferred IRA or 401k to net 10 after taxes in a 33% bracket and the 1% asset management fees. I only have to earn 11 net 10 in a max-funded IUL. So coming back to this, savvy investors use max-funded index universal life because they understand how money works. How do banks, credit unions, insurance companies make money? Well, if you don't understand this, there's basically 4 things you can do with money. You can spend it, lend it, own with it, or give it away. See, I actually own and loan on the same assets. And so I won't get into how I manage my real estate equity on my real estate portfolio or my machinery and equipment, but I actually borrow for those purposes, maybe at a cost of 4.5% interest borrowing, but it's tax deductible because I do it correctly. In a 33% bracket, it doesn't cost me 4.5%. Every million I borrow, I shell out $45,000 a year in interest, but that's not a foe, that's a friend, because it's making me money. That $45,000 is deductible. In a 33% bracket, I'm saving $15,000 in tax. The net cost of a 4.5% tax deductible mortgage is only $3,000. So I pay $30,000 a year in interest on $1 million mortgage, but on my IUL policies, I'm making at least 9%. $90,000 tax-free. And then it compounds. But the very first year I'm making 90, it only cost me 30. How much more is 90 than 30? It's 3 times. It's 300%. I often say, would you hire an employee for $30,000 that made you an extra $90,000? Yeah, you're getting a 300% return on the employment cost. So when people ask the question, well, so how do you use a max-funded IUL to become your own banker? Okay. So let's just say that you accumulate at least $1 million inside of an IUL policy. I have many clients that have $1 million, $2 million, $10 million, and they get it. They're savvy investors. They know how money works. Now you can extrapolate from this if you only have 10,000 or 100,000, or if you have 100 million in there. So if you have $1 million, I'm going to use an actual example, and I have several business owning clients that do this. They'll borrow $1 million. Just recently, my son had he had a client that borrowed $1 million for 2 years out of his policy, and the IUL policy wasn't even 5 years old. It wasn't even maximum funded yet. but he used it for his business and it was totally tax-free. But he did it the smart way. What's the smart way? Well, it's the same way my client did in 2017. He's a major real estate developer, and he usually will buy properties and develop them, or he'll buy existing properties from people who want out. So he called me in 2017, and he said, Doug, I need $1 million. See, he uses his IUL as working capital. And so he said, I need $1 million to tie up a piece of property for an earnest money. How soon do you need it? Oh, he said, I don't need it in 24 hours, but by the end of the week would be great. And so I said, okay, I'll email you the form. He knows the form. It's 1 page. He puts his name and his policy number, and then it simply asks, okay, how much money do you want? $1 million. Do you want to withdraw $1 million? He doesn't check that box. Why? If he withdrew $1 million out of his money, it's no longer in there earning interest. Okay? So he does it the smart way. I want to borrow $1 million from you, Mr. Insurance Company, and I want my $1 million to stay there earning interest. Okay, well, there's 2 ways to borrow. There's the zero cost or zero wash loan, where you can borrow the $1 million. They'll charge you, let's say, 2%, but then they credit the $1 million that is collateralizing that loan the same 2%. They charge you 20, they credit you 20,000. Okay. It doesn't cost you anything, but it's tax-free because you don't pay income tax on loan proceeds. It's tax-free. And then he doesn't have to put it back. He keeps earning compound interest tax-free at 2%. It keeps getting accruing at 2%, but it's a zero wash, okay? But he can pay it back when he wants. If he withdraws his money, he can't put the money back into there. So that's why it's the smart way. Now, he didn't choose that option. What's the last option? Would you like an index loan? Absolutely. That's what I do. What's an index loan? That's where the insurance company does not take the $1 million and carve it out and credit you 2% and charge you 2% on the loan. That means that the insurance company is going to keep the $1 million, and maybe, at the time he had $3 or $4 million, he only needed $1 million of his $3 or $4 million that was in his IUL policy. He wants all of his money to be earning the indexed rate linked to the market, where he's averaging 11 and netting 10, okay? So he wants to keep earning 10% net on all of his money. He doesn't want $1 million of it not to earn that and only earn 2%. Does this make sense? So in order to do that, the insurance company has to charge him a higher interest rate. So he agreed to that, which was 5% in 2017. So they loaned him $1 million. The insurance company loaned him $1 million, but it was collateralized by $1 million of his $3 or $4 million of cash value. But he has his whole $3 or $4 million continuing to earn 11%, netting 10. Are you getting it? That year, the $1 million that he borrowed, he turned into $3 million buying, fixing up, and flipping an apartment complex. But while he was using, technically, his money, it was really the insurance company's money, but it was really his money, it was still in there earning interest. That year, he capped out, and they credited him 25% on that $1 million, $250,000. So if you do the math, he was credited $250,000 tax-free on the $1 million that he used as collateral. If you subtract the $50,000 of the interest, he netted 20% or $200,000 tax-free on his $1 million while he was using it to make $3 million buying and flipping real estate. He uses max funded IUL as a working capital account because he understands how money works. He was making 500% more than the cost of the loan on his IUL. This is how you can make 5 times more than the cost of a loan. Frankly, there have been times where we've had clients borrow at 5% and earn 61% on their IUL, like during COVID-19, March of 2020 to March of 2021, when we told our clients to link to a 1-year point-to-point with no cap, and they got credited 61%. Folks, this is a no-brainer. If you want to understand how to do what savvy investors do, become your own banker, I would recommend you study how to do this. And in my book, The Laser Fund, it's my 11th book. It's been flying off of our warehouse shelves. You can get this 300-page book, which is actually 2 books in one. This side is about 200 pages, 14 chapters for the left brain learner with all the charts and graphs and explanations. If you're more of a right brain learner, you learn by stories and examples. You flip over and read this book. This is about 100 pages, 12 chapters with 62 actual client stories. If you want to use your whole brain, you can read the left brain and the right brain. But if you go to Amazon, these are $20 plus you pay shipping and handling. If you do that, thank you. But I'll gift you a copy free. To claim your free copy, simply go to laserfund, laserfund.com, or click on the link below. You contribute a nominal amount towards the shipping and handling. I require some skin in the game, but I'll pay for the book. I'll fire out a hard copy to you via priority mail the next day. But while you're in there claiming your free copy, if you like to listen and learn or watch and learn, check out the audio and video formats. You can also register for a free educational webinar, which we teach on a regular basis. You can even schedule an appointment to talk to an IUL specialist that I mentor and oversee. And with no cost or obligation, they can create some hypothetical illustrations with your numbers to see how to structure this correctly so that you can earn 11 and net 10. Because if you go to any insurance agent that says, oh, I sell IUL, you may be in danger of only earning 7 and netting 4 because they didn't know how to structure it right. So I would recommend you go to an IUL Insider, which is the name of the coalition or network of 1,000 agents that invest time, energy, and money to know that they're doing it correctly. And they're being mentored how to do it right. This is about you and your serious cash, and I don't want you to jeopardize your serious cash.